Bain Capital is a global alternative investment firm based in Boston, Massachusetts. It specializes in private equity, venture capital and credit products. Bain Capital invests across a range of industry sectors and geographic regions. As of June 2014, the firm managed more than $75 billion of investor capital across its various investment platforms. The firm was founded in 1984 by partners from the consulting firm Bain Company. Since inception, it has invested in or acquired hundreds of companies including AMC Theatres, Aspen Education Group, Brookstone, Burger King, Burlington Coat Factory, Canada Goose, Dick Entertainment, Domino's Pizza, Double Click, Dunkin' Donuts, D&M Holdings, Guitar Center, Hospital Corporation of America, iHeartMedia, Sealy, Sports Authority, Staples, Toys R Us, Warner Music Group, Fingerhut, The Weather Channel, and Apple Leisure Group, which includes Am Resorts and Apple Vacations. As of 2014, Bain Capital employs more than 900 people. Bain Capital is headquartered at the John Hancock Tower in Boston, Massachusetts, with additional offices in New York City, Chicago, Palo Alto, San Francisco, Dublin, London, Luxembourg, Munich, Hong Kong, Shanghai, Mumbai, Tokyo and Melbourne. The company, and its actions during its first 15 years, became the subject of political and media scrutiny as a result of co-founder Mitt Romney's later political career, especially his 2012 presidential campaign. History. 1984 founding and early history. Bain Capital was founded in 1984 by Bain Company partners Mitt Romney, T. Coleman Andrews III, and Eric Chris, after Bill Bain had offered Romney the chance to head a new venture that would invest in companies and apply Bain's consulting techniques to improve operations. In addition to the three founding partners, the early team included Fraser Bullock, Robert F. White, Joshua Bekenstein, Adam Kirsch, and Jeffrey S. Raynett. Romney initially had the titles of President and Managing General Partner. He later became referred to as Managing Director, a CEO as well. He was also the sole shareholder of the firm. At the beginning, the firm had fewer than 10 employees. In the face of skepticism from potential investors, Romney and his partners spent a year raising the $37 million in funds needed to start the new operation. Bain partners put in $12 million of their own money and sourced the rest from wealthy individuals. Early investors included Boston real estate mogul Mortimer Zuckerman and Robert Kraft, the owner of the New England Patriots football team. They also included members of elite Salvadoran families who fled the country's civil war. They and other wealthy Latin Americans invested $9 million primarily through offshore companies registered in Panama. While Bain Capital was founded by Bain executives, the firm was not an affiliate or a division of Bain Company but rather a completely separate company. Initially, the two firms shared the same offices in an office tower at Copley Place in Boston, and a similar approach to improving business operations. However, the two firms had put in place certain protections to avoid sharing information between the two companies, and the Bain Company executives had the ability to veto investments that posed potential conflicts of interest. Bain Capital also provided an investment opportunity for partners of Bain Company. The firm initially gave a cut of its profits to Bain Company, but Romney later persuaded Bill Bain to give that up. The Bain Capital team was initially reluctant to invest its capital. By 1985, things were going poorly enough that Romney considered closing the operation, returning investors' money back to them, and having the partners go back to their old positions. The partners saw weak spots in so many potential deals that by 1986, very few had been done. At first, Bain Capital focused on venture capital opportunities. One of Bain's earliest and most notable venture investments was in Staples, Inc., the office supply retailer. In 1986, Bain provided $4.5 million to two supermarket executives, Leo Kahn and Thomas G. Stemberg, to open an office supply supermarket in Brighton, Massachusetts. The fast-growing retail chain went public in 1989. By 1996, the company had grown to over 1,100 stores, and as of fiscal year-end January 2012, Staples reached over $20 billion in sales, nearly $1 billion in net income, 87,000 employees, and 2,295 stores. Bain Capital eventually reaped the nearly sevenfold return on its investment, and Romney sat on the Staples board of directors for over a decade. Another very successful investment occurred in 1986 when $1 million was invested in medical equipment maker Coach, which eventually returned $34 million. A few years later, Bain Capital made an investment in the technology research outfit the Gartner Group, which ended up returning a 16-fold gain. Bain invested the $37 million of capital in its first fund in 20 companies, and by 1989 was generating an annualized return in excess of 50%. By the end of the decade, Bain's second fund, raised in 1987, had deployed $106 million into 13 investments. As the firm began organizing her round funds, each such fund was run by a specific general partnership that included all Bain Capital executives as well as others, which in turn was controlled by Bain Capital Inc., the management company that Romney had full ownership control of. As CEO, Romney had a final say in every deal made. 1990s. Beginning in 1989, the firm, which began as a venture capital source investing in start-up companies, adjusted its strategy to focus on leveraged buyouts and growth capital investments in more mature companies. The model was to buy existing firms with money mostly borrowed against their assets, partner with existing management to apply Bain methodology to their operations, and sell them off in a few years. Existing CEOs were offered large equity stakes in the process, owing to Bain Capital's belief in the emerging agency theory that CEOs should be bound to maximizing shareholder value rather than other goals. By the end of 1990, Bain had raised $175 million of capital and financed 35 companies with combined revenues of $3.5 billion. In July 1992, Bain acquired Ampad from Mead Corporation, which had acquired the company in 1986. Mead, which had been experiencing difficulties integrating Ampad's products into its existing product lines, generated a cash gain of $56 million on the sale. Under Bain's ownership, the company enjoyed significant growth in sales from $106.7 million in 1992 to $583.9 million in 1996, when the company was listed on the New York Stock Exchange. Under Bain's ownership, the company also made a number of acquisitions, including writing products company SEM in July 1994, brand names from the American Trading and Production Corporation in August 1995, WR Acquisition, and the William House Regency Division of Delaware, Inc. in October 1995, Niagara Envelope Company, Inc. in 1996, and Shade Allied, Inc. in February 1997. Ampad's revenue began to decline in 1997 and the company laid off employees and closed production facilities to maintain profitability. Employment declined from 4,105 in 1996 to 3,800 in 2000. The company ceased trading on the New York Stock Exchange on December 22, 2000 and filed for bankruptcy in 2001. At the time of the bankruptcy, Bain Capital held a 34.9% equity ownership interest in the company. The assets were acquired in 2003 by Crescent Investments. Bain's 8 years of involvement in Ampad is estimated to have generated over $100 million in profits. In 1994, Bain acquired Toads, a producer of umbrellas and overshoes. 3 years later, Toads, under Bain's ownership, acquired Isotona, a producer of leather gloves. Bain, together with Thomas H. Lee Partners, acquired Experian, the consumer credit reporting business of TRW Inc. in 1996 for more than $1 billion. Formerly known as TRW's Information Systems and Services Unit, Experian is one of the leading providers of credit reports on consumers and businesses in the U.S. The company was sold to Great Universal Stores for $1.7 billion just months after being acquired. Other notable Bain investments of the late 1990s included Sealy Corporation, the manufacturer of mattresses, Alliance Laundry Systems, Domino's Pizza and Artisan Entertainment. Much of the firm's profits was earned from a relatively small number of deals, with Bain Capital's overall success and failure rate being about even. One study of 68 deals that Bain Capital made up through the 1990s found that the firm lost money or broke even on 33 of them. Another study that looked at the 8-year period following 77 deals during the same time found that in 17 cases the company went bankrupt or out of business, and in 6 cases Bain Capital lost all its investment. But 10 deals were very successful and represented 70% of the total profits. Romney had 2 diversions from Bain Capital during the first half of the decade. From January 1991 to December 1992, Romney served as the CEO of Bain & Amp Company, where he led the successful turnaround of the consulting firm. In November 1993, he took a leave of absence for his unsuccessful 1994 run for the U.S. Senate seat from Massachusetts. He returned the day after the election in November 1994. During that time, Ampad workers went on strike and asked Romney to intervene. Bain Capital lawyers asked him not to get involved, although he did meet with the workers to tell them he had no position of active authority in the matter. In 1994, Bain invested in Steel Dynamics, based in Fort Wayne, Indiana, a prosperous steel company that has grown to the 5th largest in the USA. It employs about 6,100 people and produces carbon steel products with 2010 revenues of $6.3 billion on steel shipments of 5.3 million tons. In 1993, Bain acquired the Armco Worldwide Grinding System steel plant in Kansas City, Missouri and merged it with its steel plant in Georgetown, South Carolina to form GSD Steel. The Kansas City plant had a strike in 1997 and Bain closed the plant in 2001, laying off 750 workers when it went into bankruptcy. The South Carolina plant closed in 2003 but subsequently reopened under a different owner. At the time of its bankruptcy, it reported $553.9 million in debts against $395.20 in assets. Bain reported $58.4 million in profits. The employee pension fund had a liability of $44 million. Bain's investment in Bain represented a significant investment in the medical diagnostics industry. In 1994, Bain, together with Goldman Sachs Capital Partners, completed a carve-out acquisition of Dade International, the medical diagnostics division of Baxter International, in a $440 million acquisition. Dade's private equity owners merged the company with DuPont's in vitro diagnostics business in May 1996 and subsequently with the Bain Diagnostics division of Hoextag in 1997. Eventis, the successor of Hoext, acquired 52% of the combined company. In 1999, the company reported $1.3 billion of revenue and completed a $1.25 billion leveraged recapitalization that resulted in a payout to shareholders. The dividend, taken together with other previous shareholder dividends, resulted in an 8-fold return on investment to Bain Capital and Goldman Sachs. Revenues declined from 1999 through 2002, and despite attempts to cut costs through layoffs, the company entered into bankruptcy in 2002. Following its restructuring, Dade Bain emerged from bankruptcy in 2003 and continued to operate independently until 2007, when the business was acquired by Siemens Medical Solutions. Bain and Goldman lost the remaining stock in the company as part of the bankruptcy. By the end of the decade, Bain Capital was on its way to being one of the top private equity firms in the nation, having increased its number of partners from 5 to 18, having 115 employees overall, and having $4 billion under its management. The firm's average annual return on investments was 113%. It had made between 100 and 150 deals where it acquired and then sold a company. 1999 to 2002, Romney departure and political legacy. Romney took a paid leave of absence from Bain Capital in February 1999 when he became the head of the Salt Lake Organizing Committee for the 2002 Winter Olympics. The decision caused turmoil at Bain Capital, with a power struggle ensuing. Some partners left and founded the Audax Group and Golden Gate Capital. Other partners threatened to leave, and there was a prospect of 8-figure lawsuits being filed. Romney was worried that the firm might be destroyed, but the crisis ebbed. Romney was not involved in day-to-day operations of the firm after starting the Olympics position. Those were handled by a management committee, consisting of 5 of the 14 remaining active partners with the firm. However, according to some interviews and press releases during 1999, Romney said he was keeping a part-time function at Bain. During his leave of absence, Romney continued to be listed in filings to the U.S. Securities and Exchange Commission as sole shareholder, sole director, chief executive officer, and president. The SEC filings reflected the legal reality and the ownership interest in the Bain Capital Management Company. In practice, former Bain partners have stated that Romney's attention was mostly occupied by his Olympics position. He did stay in regular contact with his partners, and traveled to meet with them several times, signing corporate and legal documents and paying attention to his own interests within the firm and to his departure negotiations. Bain Capital Fund VI in 1998 was the last one Romney was involved in. Investors were worried that with Romney gone, the firm would have trouble raising money for Bain Capital Fund VII in 2000, but in practice the $2.5 billion was raised without much trouble. His former partners have said that Romney had no role in assessing other new investments after February 1999. nor was he involved in directing the company's investment funds. Discussions over the final terms of Romney's departure dragged on during this time, with Romney negotiating for the best deal he could get and his continuing position as CEO and sole shareholder giving him the leverage to do so, although he had left open the possibility of returning to Bain after the Olympics. Romney made his crossover to politics in 1999. His separation from the firm was finalized in early 2002. Romney negotiated a 10-year retirement agreement with Bain Capital that allowed him to receive a passive profit share and interest as a retired partner in some Bain Capital entities, including buyout and Bain Capital investment funds, in exchange for his ownership in the management company. Because the private equity business continued to thrive, this deal would bring him millions of dollars in annual income. Romney was the first and last CEO of Bain Capital. Since his departure became final, it has continued to be run by a management committee. Bain Capital itself, and especially its actions and investments during its first 15 years, came under press scrutiny as the result of Romney's 2008 and 2012 presidential campaigns. Romney's leave of absence and the level of activity he had within the firm during the 1999 to 2002 period also garnered attention. Early 2000s Bain Capital began the new decade by closing on its seventh fund, Bain Capital Fund 7, with over $3.1 billion of investor commitments. The firm's most notable investments in 2000 included the $700 million acquisition of Datek, the online stock brokerage firm, as well as the $305 million acquisition of KB Toys from Consolidated Stores. Datek was ultimately merged with Ameritrade in 2002. KB Toys, which had been financially troubled since the 1990s as a result of increased pressure from national discount chains such as Walmart and Target, filed for Chapter 11 bankruptcy protection in January 2004. Bain had been able to recover value on its investment through a dividend recapitalization in 2003. In early 2001, Bain agreed to purchase a 30% stake worth $600 million in Huntsman Corporation, a leading chemical company owned by John Huntsman, Sr., but the deal was never completed. With a significant amount of committed capital in its new fund available for investment, Bain was one of a handful of private equity investors capable of completing large transactions in the adverse conditions of the early 2000s recession. In July 2002, Bain, together with TPG Capital and Goldman Sachs Capital Partners, announced the high-profile $2.3 billion leveraged buyout of Burger King from Diageo. However, in November the original transaction collapsed when Burger King failed to meet certain performance targets. In December 2002, Bain and its co-investors agreed on a reduced $1.5 billion purchase price for the investment. The Bain consortium had support from Burger King's franchisees, who controlled approximately 92% of Burger King restaurants at the time of the transaction. Under its new owners, Burger King underwent a major brand overhaul, including the use of the Burger King character in advertising. In February 2006, Burger King announced plans for an initial public offering. In late 2002, Bain remained active, acquiring Houghton Mifflin for $1.28 billion, together with Thomas H. Lee Partners and Blackstone Group. Houghton Mifflin and Burger King represented two of the first large club deals completed since the collapse of the dot-com bubble. In November 2003, Bain completed an investment in Warner Music Group. In 2004, Bain acquired the Dollarama chain of dollar stores based in Montreal, Quebec. Canada and operating stores in the provinces of Eastern Canada for $1.05 billion CAD. In March 2004, Bain acquired Brenntag Group from Deutsche Bahn AG. In August 2003, Bain acquired a 50% interest in Bombardier Inc.'s recreational products division, along with the Bombardier family and the Caisse de Acute Pota Placement du Québec, and created Bombardier Recreational Products BRP. Bain and the 2000s buyout boom. In 2004, a consortium comprising KKR, Bain Capital and real estate development company Vornado Realty Trust announced the $6.6 billion acquisition of Toys R Us, the toy retailer. A month earlier, Cerberus Capital Management made a $5.5 billion offer for both the toy and baby supplies businesses. The Toys R Us buyout was one of the largest in several years. Following this transaction, by the end of 2004 and in 2005, major buyouts were once again becoming common, and market observers were stunned by the leverage levels and financing terms obtained by financial sponsors in the buyouts. The following year, in 2005, Bain was one of 7 private equity firms involved in the buyout of SunGard in a transaction valued at $11.3 billion. Bain's partners in the acquisition were Silver Lake Partners, TPG Capital, Goldman Sachs Capital Partners, Kohlberg Kravis Roberts, Providence Equity Partners, and Blackstone Group. This represented the largest leveraged buyout completed since the takeover of Vargey Nabisco at the end of the 1980s leveraged buyout boom. Also, at the time of its announcement, SunGard would be the largest buyout of a technology company in history, a distinction it would cede to the buyout of Freescale Semiconductor. The SunGard transaction is also notable in the number of firms involved in the transaction, the largest club deal completed to that point. The involvement of 7 firms in the consortium was criticized by investors in private equity who considered cross-holdings among firms to be generally unattractive. Bain led a consortium, together with the Carlyle Group and Thomas H. Lee Partners, to acquire Dunkin' Brands. The private equity firms paid $2.425 billion in cash for the parent company of Dunkin' Donuts and Baskin-Robbins in December 2005. In 2006, Bain Capital and Kohlberg Kravis Roberts, together with Merrill Lynch and the Frist family, completed a $31.6 billion acquisition of Hospital Corporation of America, 17 years after it was taken private for the first time in a management buyout. At the time of its announcement, the HCA buyout would be the first of several to set new records for the largest buyout, eclipsing the 1989 buyout of Vargey Nabisco. It would later be surpassed by the buyouts of Equity Office Properties and TXU. In August 2006, Bain was part of the consortium, together with Kohlberg Kravis Roberts, Silver Lake Partners and Alpinvest Partners, that acquired a controlling 80.1% share of semiconductors unit of Philips for €6.4 billion. The new company, based in the Netherlands, was renamed NXP Semiconductors. During the buyout boom, Bain was active in the acquisition of various retail businesses. In January 2006, Bain announced the acquisition of Burlington Coat Factory, a discount retailer operating 367 department stores in 42 states, in a $2 billion buyout transaction. 6 months later, in October 2006, Bain and the Blackstone Group acquired Michaels Stores, the largest arts and crafts retailer in North America, in a $6 billion leveraged buyout. Bain and Blackstone narrowly beat out Kohlberg Kravis Roberts and TPG Capital in an auction for the company. In June 2007, Bain agreed to acquire HD Supply, the wholesale construction supply business of Home Depot, for $10.3 billion. Bain, along with partners Carlyle Group and Clayton, Dubier and Amp Rice, would later negotiate a lower price when the initial stages of the subprime mortgage crisis caused lenders to seek to renegotiate the terms of the acquisition financing. Just days after the announcement of the HD Supply deal, on June 27, Bain announced the acquisition of Guitar Center, the leading musical equipment retailer in the U.S. Bain paid $1.9 billion, plus $200 million in assumed debt, representing a 26% premium to the stock's closing price prior to the announcement. Bain also acquired Edcon Limited, which operates Edgar's department stores in South Africa and Zimbabwe, for R25 billion in February 2007. Other investments during the buyout boom included Bavaria Yacht Bor, acquired for €1.3 billion in July 2007, as well as Sensata Technologies, acquired from Texas Instruments in 2006 for approximately $3 billion. In the wake of the closure of the credit markets in 2007 and 2008, Bain managed to close only a small number of sizable transactions. In July 2008, Bain, together with NBC Universal and Blackstone Group, agreed to purchase the Weather Channel from Landmark Communications. Subsequent investments include, but are not limited to, July 2008, Bain, together with Thomas H. Lee Partners, acquired Clear Channel Communications. July 2008, Bain acquired D&M Holdings for $442 million. June 2009, Bain Capital announced a deal to acquire a 9-to-23% stake in Chinese electronics manufacturer GOM Electrical Appliances for $233-432 million. March 2010, Bain acquired Styron, a division of the Dow Chemical Company, for $1.6 billion. October 2010, Bain acquired Gymboree for $1.8 billion. July 2011, Bain acquired Securitas Direct AB together with Hellman and Amp Friedman. January 2012, Bain acquired Physio Control for $478 million. August 2012, Bain Capital announced that it had entered into an agreement to acquire a 30.49% stake in Genpact Limited, India's largest BPO call center outsourcing firm, from General Atlantic LLC in Oak Hill Capital Partners for $1 billion US. October 2012, Bain Capital acquired hand and power tool company Apex Tool Group from Cooper Industries and Danaher Corporation for a fee of around $1.6 billion. May 2013, Bain Capital and investment firms Golden Gate Capital, GIC Private Limited, and Insight Venture Partners entered into agreement to purchase BMC Software for a fee of around $6.9 billion. December 2013, Bain Capital acquired a majority stake in the clothing chain Canada Goose Inc. 2013, Bain purchased Apple Vacations, Am Resorts, Travel Impressions, and Cheap Caribbean to form Apple Leisure Group. November 2014, Bain Capital and Virgin Group announced they were creating a new cruise line, Virgin Holidays Cruises. December 2014, Bain Capital agreed to a purchase of 4 divisions of CRH for a sum of £414 million, including its subsidiary Ibstock. March 2015, Bain agrees to buy Blue Coat Systems for around $2.6 $1.4 billion. In 2016, the firm elevated Jonathan Levine and John Connaughton to co-managing partners, while also naming Stephen Paluca and Joshua Bekenstein co-chairman of the firm.